Gort Show is sponsored by Ellipsis Labs. Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. You may know of Ellipsis Labs by their first product, Phoenix, a fully on-chain order book DEX that's done over $50 billion in unincentivized volume. This is one of the strongest teams I know in crypto. If you're interested in working for a mission-driven company, Ellipsis Labs is hiring engineers who are passionate about crypto and finance to work on Atlas. You can learn more and apply on Ellipsis Labs Twitter, @ellipsis_labs. Don't forget to check out Atlas too, @AtlasXYZ on Twitter. Hey guys, today I have on Kevin Mills from Triton Liquid Fund. So Kevin wrote a paper recently called What is Ethereum Worth? And this is a follow-up. Wait, sorry. It is called What is Ethereum Worth, right?
Yeah.
That's the website name.
That's both. Yeah. The website name is just an easier way to get a hold of it.
Okay. So a little bit of context for this conversation is that there was a paper written in 2017 by John Pfeifer called The Institutional Investor's Guide to Crypto Assets. And I think it has had as much of an impact as anything I've read on how I view this space. And I have been increasingly thinking about this as of late and thinking about, how much can we kind of revisit and apply to the original writing, which we'll talk about. And I stumbled across Kevin, who had written what I think is a tremendous explainer and follow-up to this paper. So I'm very happy to have him on today. It's hopefully going to get, I say hopefully, it's almost certainly going to get pretty dense at times, but I'm really looking forward to this. But yeah, Kevin, if you want to introduce yourself and give us just a brief background.
You betcha. And yeah, thanks for having me on. So I'm, as you mentioned, at Triton Liquid. So I'm the head of research here. We are a liquid fund investing in tokens, spun out of a tier 1 VC in about May, and we've been writing our own book since. So we're relatively new on the scene, but we have been investing in the strategy for a couple of years now. In terms of really the paper and all that, I think anyone that's been around in the space since 2 cycles ago now, 2017, have probably at least read it once, even if they don't remember, or if not, it's been a pretty foundational piece of how, a lot of people were looking at these assets at the time. And with John and his paper, what was really striking, if you go back and read that now, is so many of his forecasts and his predictions. And he was writing this before the merge, before any of these L2s or any of these really things really happened, have played out exactly as he called it. And so if you go back, you really have to just appreciate kind of his foresight, what he saw there. And then we were kind of talking about this with him and asked, hey, would you like to, are you open to us approaching or reopening this with you? Taking another look at this and honestly, just getting this back out, because I think it's kind of fallen to the wayside a little bit. And he was open to that discussion. I will caveat that anything I say on the show is my view, not his. So he might have heartburn with some of the stuff I say, but that's okay. I look forward to jumping into this.
Yeah. So I would I'll let you give a brief overview of the original paper, and then we can sort of focus on the follow-up that you've given. But I would say that one reason in particular that I think this paper stands out amongst a tremendous number of writings is because this is something that I think puts aside a lot of the ideological and nebulous kind of beliefs that people hold in this space that, for what they're worth, were really the space really emerged on these principles, but they may not really give us any indication as to how to value assets or how to understand the economics of this stuff. And so I wanted to clarify that I have always found this piece to be especially elucidating on the grounds that a lot of these kind of ideas about decentralization and cypherpunk and all this stuff, right? Those can exist, but let's look at this sort of from a purely, address this as from economics or finance, right? And try to understand it that way. So to that end, can you give us just a brief overview of what the essence of the original paper was, and then we can jump into yours?
Yeah, absolutely. And so I think it's important just to understand what lens an investor like John looks through these things, right? He was at KKR, McKinsey, very much institutional background. And he's looking at these things 5, 10, 15 years into the future. And when you look at just really the dynamics of crypto assets, right, it's tough to make a case that the actual value capture of open source protocols, open source networks, and just those defensible moats over the long run are as sustainable relative to your traditional companies. Right. And I think that's where a lot of this, that's kind of the underpinning principle here. Right. And there's a certain extent where Bitcoin has started to separate itself from the pack a little bit as its, non-sovereign store of wealth. That narrative, digital gold, that has caught on. But once you take a step, down that ladder into Ethereum, Solana, and all these other kind of smart contract platforms, all of a sudden now the competitive dynamics there are just such that people are going to be spinning up these forks, and competitive chains, and then each kind of marginal benefit that a chain that has right now, that's just going to get eroded by the next one to come across, right? And you're seeing this play out. Like I can't even count how many chains there are. I think L2 Beats got about 150 L2s that they're tracking right now, not to mention L3s, all the Move VM chains coming out, SVM, Solana is now starting to face with Alt SVMs, L2s. And this is really that dynamic at play. And really the crux of the core paper was from an investor who's committed to locking up capital for 5-10 years and looking at any of these assets. That's a pretty tough pill to swallow, and that just makes it a very, very difficult space for institutional capital to get comfortable with, right? And that's really the crux of that first paper. And so kind of transitioning to 2025, or I guess 2024 when we wrote this, we wanted to reevaluate it based on, okay, things have changed. A lot has stayed the same, but there are some differences now. And there are funds in the space that, there's a couple of funds back in the day in 2017. There are some now that, can underwrite these things, can move fast enough. The infrastructure is there, the liquidity is there, that you can underwrite these things on maybe a 6-month basis or a year basis. And as a portfolio, the investment makes a little bit more sense. But you still have to be aware of all those same dynamics that are at play. Right, like the forks, the erosion of value capture, the sustainable rent, all that stuff is still very, very difficult. And you can look across any vertical, any protocol, and you can see it playing out in real time.
So I think that one thing I would just note about the first paper was that John, from his perspective, approached these networks basically in two ways. And I'm sort of simplifying this, but he basically approached these blockchain networks, if you will, and the tokens that support them from one of two ways. The first was the non-sovereign store value, digital gold, whatever it may be. But the rationale there was, look, there's likely to be a single non-sovereign store value that wins in the long term. We'll talk more about this later, right? Because I have a lot of kind of counter arguments that I think a lot of my listeners would at least want me to press you on. But that was one, that was one side of this equation. The other side of this equation was very much on the utility token aspect. And the reason I'm kind of setting this up is for you to kind of transition into the first model of valuation that you guys used, which was cash flows. And John never really looked at these from the perspective of a sustainable, moatable rent capturing, network. And I think you guys kind of came to the same conclusion, but you talked about it in your paper. Maybe if you were to look at this, not even a DCF, but just like some, high growth multiple of earnings or whatever. So yeah, like what was that was the first, that was the first valuation method you used. What was like sort of your conclusions with that, or maybe break down how you went about that?
Yeah, you bet. So to set the scene a little bit there, right? We really wanted to get into the conversation here. Like we've been watching this ETH kind of dynamic play out for a couple months, back into the summer, and it seems to be a bit of an identity crisis, right? And so we really wanted to just take a step back and just contribute to the conversation in that, okay, you can look at it as a cash flowing asset. You can look at this thing as, an internet commodity, and you can look at it as money, and maybe some combination of those three, right? But those are really the three main lenses that you can look at it. And increasingly, we were seeing both a disconnect and almost like a polarization within certain camps about what ETH really is. And just off the top, as investors, as Wall Street's looking at the ETFs and all this, that's not a good thing if the protocol, the governance, the community has no idea what they're actually building. right? And so some other people like John Schreiber put out stuff like North Star, and like there's been all of this, and you're starting to see signs that ETH is and the community are responding, right? Which is fantastic. So with that all said, right? If you look at this thing as a cash flowing asset, and honestly, there is a reason and a viable path to doing that. If you have a stake in the network, you can earn your 3%, but that is 3% of real cash, both from issuance and from fees and burns, which are in effect a dividend to a certain extent, right? And so as a cash flowing asset, that is true to a certain extent, right? But if you're trying to now compare that to equities, which is what that opens that conversation to be, all of a sudden now those valuations just kind of blow out the window on you, right? Like as a quick comp, right? AWS does what, $100 billion per year of revenue, something like that, and right, and so that would be a dream if you told me that Ethereum was as dominant and used as widely across the world as AWS. Amazing. But at the same time, if you look at like Amazon's what, a $2.5 trillion company right now. So, and what portion of that is AWS? Maybe 500 billion to a trillion of that, depending on what multiple you want to subscribe, right? But cloud, you're trading at roughly 5 to 6 on revenues. So all of a sudden now the 2.5 billion or so of revenue and fees that Ethereum has generated, you're not getting to $500 billion, right? And then that's kind of the problem. So it is, if you want to value it that way, and you're an investor and you want to stake ETH and you earn your 3% based on the issuance and the fees, 100%. But you're not going to get to a multi-trillion-dollar outcome like a lot of people are suggesting you should. And so that's really that lens there, and why we have so much heartburn with it.
Yeah. You also noted, and I thought this was interesting, and it's sort of an oft forgotten or left out point, which is that when you denominate in ETH, it becomes sort of a death knell, as you said, for the cash flow model. Like, what did you mean by that? If you don't mind kind of explaining that.
Yeah. So the biggest thing there is it's kind of the circularity issue, right? So you could have, and the simplest way, you could have all else equal, the same number of transactions, the same number of use, but all of a sudden now, if ETH goes from 1,000 to 2,000, like the value of the network that generated that all of a sudden doubled, right? And right. So there's no extrinsic kind of anchor to this that, right. And you kind of get into that issue, right? It'd be and we kind of use this example. It'd be like, okay, if you're pricing Apple in the shares of Apple, right? Exactly. You're looking at its revenue in terms of that, right? But people are buying their phones in shares of Apple, and people are, paying for the App Store in the shares of Apple. And there is this closed circle that you can't really escape. And that makes it almost impossible to really value this thing based on like incremental cash flow. Because if what you're pricing it in is moving up and down 25 to 50% in a year, what is your actual cash flow, right? So that's kind of a pretty big issue to get around.
So you alluded to the issuance looking like it is codified around roughly 1% a year. Do you think that this was sort of misunderstood, at least by the community? And the problem with this, and this, we'll also talk about this again with kind of like the internet bond valuation that you guys use, but the problem that I've sort of had with this is that it's much more, like you said, it's much more akin to a company issuing shares in perpetuity. And at times those shares come back out of circulation. But the problem is that you aren't, well, I'm kind of jumping around now. With the bond analogy, you can't really value that as sort of a stable currency. In this case, in this scenario though, can you really look at cash flows how do you view the long run of this cash flow with taking into account this sort of codified 1% to 1.5, maximum issuance per year?
Right. And yeah, so with that, and I also just, while we're on this topic, is like the whole burn narrative, the ultrasound, like I do think that is a bit of a, a red herring in the sense that honestly, 1% of inflation is not much at all. Right. And so, like in terms of that monetary policy, that's fine. And up to maybe 1.5%. And like that's okay, right? For an asset that is growing as fast as crypto and ETH, that is okay. But so but what that does is it kind of gives you almost like, to a certain extent, a ceiling on a majority of what you can expect to generate from staking, right? The rest of it, so yeah, you can get your issuance, you're getting your 1.5% plus, or your share of the 1.5% across the network. So you're getting, 3%, whatever that works out to. But then everything else has to come from the actual growth in the adoption of the network, which is the burn and then priority fees. Right. And so, sure, you have your steady state 3% on your issuance. And then the variable where you're actually going to benefit from the growth of the network is the burn and is really the execution piece, right? The burn and the issuance, or the priority fees. And that's where we have so much trouble getting on board, is because the entire roadmap is pushing this thing off to L2s. And so not only does that reduce the priority fees, the competition for that block space on L1, it also definitionally reduces every other transaction that happens on the L1 because of how the fee markets work, right? Especially once you shift to the L2s to blobs. And so when we look at this, I'm like, okay, you're pushing away the only variable upside kind of revenue generation mechanism, and asking the investors to just be okay, just not getting diluted, plus, or plus the holder share of the chain, right? And that just gets pretty problematic in terms of being able to underwrite that at any sustainable or high multiples.
And this is kind of the point that I was alluding to pretty inarticulately earlier, which is that the actual net earnings, or again, sort of terminology is kind of difficult with this stuff, but the actual, I guess recently we've used this REV metric. That actual amount is very small relative to just the aggregate yield you receive. And so I was looking at this, and for example, like on ultrasoundmoney.com, the MEV and tips are about 12.5% of the aggregate yield you receive. Now, there's burn on the other side of this, but the point is just that that's not an incentive to hold an asset. And that's kind of the key aspect to me. And I just, because I'm not sure that I'm putting this in very simple terms, like let's say that 32 ETH is $100,000 for simplicity's sake, and you're earning $3,500 a year yield. Okay, maybe $500 of that $3,500 of that $3,500 is actually this real upside growth potential, and that right there is not a return to incentivize you to hold, right? It's not like a cash flow from that perspective. So you really need an additional, store of value narrative or whatever it may be to hold that. But I just like to put that into perspective. And I think that's kind of, I mean, I've had some kind of qualms with the REV metric. I understand why it's used. I also think it is a good metric, but at the same time, it discounts a big part of how I kind of view this stuff. So that the cash flow point, I think, is you said you have such heartburn with it. Yeah, it's very unlikely that we really ever look at ETH this way. Okay, let's move on to the next sort of method of valuation, which is the equation of exchange, which in many ways I think is the most compelling. It's extremely bearish for what it's worth. But I would love for you to explain this. And this is also really what John focused on in his paper, sort of contrasting this with the store of value, narrative. And yeah, like I love you start digging in. I'll probe when I see necessary.
Sure. Yeah. And as we go through this, and to your point, like it does sound bearish. And I do also want to say I'm not an ETH bear. I'm not fighting this, but despite what it sounds like the paper says, I'm an Ethereum. I love what EVM is and what Ethereum is building, but ETH as an investable asset is separate from that. Right. And I just want to make sure that is clear here, this distinction. Right. And then so as a segue, if we look at this kind of ETH is, money conversation, right, which is where that equation exchange comes in, you kind of have to really understand what the size of ETH's GDP is, right? Because money to support GDP is really, three pieces of that equation, the fourth being like velocity. And when you actually look at the size of Ethereum's GDP, and we kind of broke this down into like L1 revenue, L1 apps, L2 revenue, L2 apps, right? And made a pretty broad assumption that every dollar transacted across any of those is done in ETH, right? And that's a pretty accommodative a look at it. Whereas, obviously all these things, USDC, tokens, there's so many other ways to pay for all this. And what we found is, over a 6-month period, we found roughly 1.4 billion or so in total app and chain revenue, essentially. And so, annualize that out times 2, just under 3 billion or so. And that's tiny, right? That is a tiny, tiny economy still, despite how much is going on. But the end of the day is a lot of these things just don't have that much revenue, as much as we like to think they do. And then, so if you actually take a look at this equation of exchange, right? ETH's velocity has settled around 7 or so. A few different data sources here, and we're actually talking before the show. Chris Berniski actually forecast this like almost 8 years ago now, which is incredibly impressive. But it's right around that seven range. And if you actually kind of calculate how much money stock you need to support a $3 billion economy, you're talking a pretty small number, right? Like maybe 1/1000th of what we're seeing right now, like in the 200 to 400 million range. And so as money, all of a sudden now the entirety of ETH's value comes from its monetary premium, right? This kind of fuzzy concept that suggests something should be worth hundreds of billions or trillions of dollars. But if you actually compare ETH money stock, if we actually step back and look at it as like the M0, which is probably the best way, because these are like the most base layer kind of way to look at money. And it abstracts out like all the M1 and M2 fractionalized deposits and all that fun stuff. M0, ETH's already the 6th biggest in the world, or 7th biggest. It's bigger than the Hong Kong dollar, the Australian dollar, the Canadian dollar. And as a emerging kind of virtual country, which the internet, like fine, tons of reach, transcends borders, absolutely. But the only currencies above this are the Swiss franc, the euro, the yen, the yuan, the US dollar. Which one of those should ETH flip based on its size of adoption, right? And that's tough to justify in any rational sense as well. So the only really remaining thing here is has this monetary premium that makes it worth all this. And I guess the market has proven that that's to a certain extent the case, but I'm not sure that all of a sudden makes it worth, based on the risk, based on the competitive dynamics of this industry. You have to underwrite this thing at probably 30 to 40%. I'm not sure all of a sudden you can get comfortable that you're going to get multiples of return on that just based on that monetary premium expansion. And that's kind of where this argument kind of starts to fall apart too. I mean, the 6th largest currency in the world, that's success by any stretch of the imagination. If you told someone back in 2014 ETH was going to be a top 10 global currency, they take it.
Yeah, for sure.
But does it mean it's going to dethrone the yuan or the euro, right? Which is the next kind of step.
I guess the question, and again, we'll get more into this later. I have some follow-ups to this, and I'll let you sort of give the final valuation. But I want to ask, like, we talk about this monetary premium idea, and like basically what we're establishing here is that ETH already has a massive monetary premium. Now, I've sort of decided on a personal level that this idea of monetary premium has kind of one-shotted this industry, because I think it leads to some discussions, and it has made people misunderstand some of these concepts. So I kind of view this as just like a speculative premium, or some premium. Saying monetary premium, I think it's funny, like, I do think monetary premium is a real thing, and I disagreed with Tolley about this. Like, I asked him, like, how do you explain the difference between sort of like the utility value of gold versus what it trades for, right? It trades for 10x its utility value. And he said supply and demand. And at the time, I was like, okay, well then, like, what do you think? That delta is what we call a monetary premium. You call it supply and demand. I think it exists, but to me, it's like nerd sniped this industry into like attempting to fixate on stuff that's just maybe not that important. And so we can just kind of call this like some premium. The point though is that this premium currently to its sort of utility value, right? Like the monetary stock needed for the Ethereum economy to function. By the way, I noticed that you left it out, but I'll go ahead and tell you, it's like $1.50, $1.50 to $3 effectively, right? Like that's literally what we're talking about on per ETH, right? So like ETH trading at, $3,200. So yeah, let's call it like 1,500 to 3,000x premium or something, right? So it is, I guess the one point I'm rambling, but the one point I would make is like one of the pushes has been towards this idea of a monetary premium. And the reality is like, guys, all of these already trade at like a gargantuan premium to something, like whether or not you call that money or not, like the fact of the matter is the actual, amount needed to support these economies is like orders of magnitude less. So yeah, I think that you bringing up the other nation state currencies is pretty hilarious, right? Like it really puts it into perspective.
Yeah. Exactly. And then when you can argue that that monetary premium does exist, like, but as you said, at this right now, that is the entirety of the value of it.
Right.
And fair enough. And there are other issues of extrapolating that premium to expand beyond kind of where it's already at. Just given some other dynamics, right?
Well, also, so like coming like a little bit full circle again, when I noted that you kind of showed up on my Twitter feed and I ended up reading your article and I was like, oh, this is fantastic. Got to have this guy on. But the initial impetus for that was I wrote this long, like stream of consciousness, mainly in retrospect, like sort of inarticulate post about this concept, but it wasn't very well articulated. Oftentimes I think that I do this where I think I'm making a good point and then I realize like maybe the point I thought I was making was just like left out. But one thing about this velocity concept, which used to be frequently discussed within crypto and has largely been put by the wayside now, is that a very high velocity means sort of definitionally you need less of this monetary stock and it also at equilibrium it drives the price down toward, and this is toward the price of gas, right? So in a more simplified explanation of this, what we see when we start, working with velocities and understanding this MV equals PQ equation is that you converge on a utility value where it's not that expensive to make these, transactions. And my point, which like I said, was sort of not well fleshed out, was I suspect that stable coins will be this kind of Trojan horse for this. And I think that in the past, we've seen a low velocity, mainly on the grounds. There's been a lot of friction between moving in and out of these assets. And so like, for example, during DeFi summer, during the ICO era, everything was denominated in ETH, right? Well, as people start to hold dollars instead of holding ETH in their wallets, and if you start spending in dollars, what's happening is that ETH is being converted in the background to pay for gas, and you're getting your, change in dollars. Well, this creates an extremely high velocity for these assets, and they start to converge by market forces on their utility value. This is the part that I think I have never like personally articulated that well when I go on a schizo post on Twitter. But this is something that I think is really critical to understand, is that, and I'll stop rambling, but the last kind of final part of this is like, what you realize is that what you really want, or what you can really ascribe value to, is almost this like very left curve mentality of like, you want diamond handed holders. Like what you want is a very low velocity. Now, you don't want a velocity of 0 because that sort of indicates there's no actual price discovery for an asset. But what you want is a store of value. And this is kind of now comes back to John's original post, which was that, he kind of looked at it like, okay, there's going to be probably a single non-sovereign, digital store value. And then the rest of these are kind of going to act as gas tokens, utility tokens. And the way these go, using the equation of exchange, is sort of toward their utility value. I don't know if you have any thoughts on that, but I was going to let you then finish on your kind of like last method of valuation, which is the internet bond.
Yeah. Yeah, no, and these dovetail perfectly. But I think where like ETH is where it is. I mean, there's obviously a large piece of speculation, but I think just people hold so much of it still and use it so frequently is just due to the tech still being pretty young, and there's a lot of inefficiencies that exist, right? And if you look at across any wallet, any chain, any protocol, everyone is trying to make it cheaper, faster to transact, right? That's what everyone's trying to do. That's Solana's entire thing, right? IBRL, right? Just
yeah,
faster
exactly.
and cheaper, right? That's everything that they're trying to do. And you see this, and then you also see a push towards abstraction everywhere you look,
Yep.
right? Whether it be through intents, whether it just be through account abstraction, anything like that. And what all of this points to, at least in my eyes, is ETH does become, based on this current roadmap, by pushing everything out and just being kind of essentially a settlement layer and a DA layer, it just becomes really a back end kind of tech stack that people just need to pay for on-demand use of, right?
Yeah.
And as all this abstraction happens, cost to acquire ETH goes to zero. Cost to transact continually goes down. It's essentially free on some of these L1s or L2s for all intents and purposes. And things like Mega ETH coming out, that who knows what that's going to do to just the entire, just view of this. But all of a sudden now there's no real dormant demand to hold sizable ETH there, right? It's going to be like, John actually uses an analogy that's like using electricity, right? Like it's there instantly. You can hold some, but it's off instantly. It's on demand, right? And you do pay for that. There are periods of when energy is expensive, it does cost more, but for all intents and purposes, you only use it when you need it. And if you extrapolate that out, it kind of just sounds like cloud compute credits at that point, right? And so on this roadmap, when you're seeing that's kind of where it's getting pigeonholed down to, it's tough to really expect that as this like highly productive asset that's so in demand for all this stuff, at maturity, a lot of those use cases do go away, and a lot of that kind of latent demand that we see there, that goes away too.
Thanks for listening to The Gort Show on the Blockspace Podcast Network. Subscribe to our newsletter at blockspace.media to get the show directly to your inbox. Show links, transcripts, and Bitcoin articles twice per week. Stay ahead of the conversation by visiting blockspace.media.
Yeah. And I think that, so this kind of goes to show how early John was and why we went through periods, I think, where some of what we saw looked to some extent to nullify some of what he said. So, for example, DeFi summer, people were locking up a lot of ETH. The ICOs all denominated in ETH. And typically when you took profit in ETH, right? The frictions were structural. And I think that John assumed a future, which we're probably just now converging on, where a lot of these frictions are, basically abstracted away entirely. Or the other, he puts forth this idea of working capital, right? Where and this is kind of, like you just were saying, was dovetailing into your internet bond idea, which is that working capital is something that companies hold on balance sheets, and they really try to minimize it on the grounds that, it's non-productive and it typically has a carrying cost. So I guess your final sort of view is this, like, can you kind of explain this working capital analogy, and like why John sort of viewed it like this to begin with, and why you've kind of, continued this line of thinking?
Yeah, you bet. And so when he wrote this, he kind of had a 10-year view on this, and so he's got about 2 years for a lot of this to play out. So we'll see if he hits that mark, or if we have to extend it at least a couple of years. But yeah, so if you view ETH as this internet native commodity productive asset, some people call it like this internet bond, right? And there's a few kind of again not problems, and this is how we view it most strongly, and we think this is the way to look at it. But again, once you get into the numbers that it's at right now, it is tough to justify there's enough demand to suggest this thing is going to increase quite a bit, 2-3x from here. Because if you look across commodities, right, ETH at 400 billion is number 5 in the world behind oil, gold, Bitcoin, and silver. So again, it's like this thing is already incredibly successful. A lot of this is because of its speculative premium that's baked in, as we've covered, ad nauseum here. But what real organic demand makes this thing worth more than this, right? Like this exists within the internet, which is a subsection of global commerce. It's not magically this thing that can transcend boundaries into trillions of dollars. And again, that's what's so problematic, because if you start looking into when you're actually going to use this asset, and I just covered probably a fair amount of this, but it does just become this instantaneous on-demand asset. In no other industry are companies optimizing to expand how much they hold on their balance sheet.
Exactly.
Right? They all want this to be like just in time is kind of the name of the game. And with an asset that is increasingly free to acquire, instantaneous to acquire, and is as volatile as Ethereum is, you don't want to hold large quantities of that on your balance sheet, right? You do want to still denominate in USD or whatever your local currency is. And that is where I think this productive piece starts to kind of break down a bit, right? Because you're not going to be just stockpiling all of this Ethereum.
Yeah.
You're really going to try to minimize how much you have of it.
Yeah.
And as you mentioned, like with abstraction and especially stable coins, you're already seeing this with some networks. Like you can just pay in like, I think Lens uses Go now, right? You can like pay in stables. USDC has had this in their contracts since like, I think the 2.1 upgrade, where you can like gas the sends and all that. You can do this with stable coins. And increasingly, as we've kind of probably hit where retail is the main drivers, for us to get to the next level, it's businesses, right?
Exactly.
And they want to denominate in USD.
Okay.
And they'll do that in stables, yeah.
You brought up one point, again, from the original paper when I read it. One thing that stood out to me that you ended up addressing, and so maybe you could consider this a bit of a counter argument. I don't know that it really has much of an impact on valuation necessarily, but it is somewhat of a counter argument, and you've fleshed it out, very well. Which is my first thought, or one of my first thoughts was, okay, the carrying costs of a digital currency are some order of magnitude lower. So like compare, I'm a naive example, a trucking company, right, wants to minimize the amount of oil it holds on its balance sheet, on the grounds that there's, storage and carrying costs, and it's quite volatile. Well, digital oil, right, may be a bit different in the sense, and like I said, you addressed this, the kind of marginal cost for each additional unit converges on zero, essentially immediately. So that is a point to be made, which is that maybe companies would stockpile, maybe there would be some sort of liquidity sinks on the grounds that adding this version of working capital is not nearly as expensive. What do you think?
Yeah, and that's fair, right? Because I think most people default like, okay, you gotta have a free hot wallet, or you have like your hardware wallet, right? So maybe $100. But I think once you get into kind of the commercial scale, the kind of institutional scale, what companies, what funds, like there's not a single fund out there using a MetaMask. I'm sorry, right? And there's real costs to custodying and storing digital assets. Like it's no longer $100 for kind of commercial quote unquote scale. And so all of a sudden there is true opportunity cost of that capital, ongoing costs involved with holding that. And then the moment you put that into cold storage, it's not really an on-demand asset anymore. There's all the frictions involved of actually, and it kind of defeats the purpose of having this instantaneously available kind of compute resource. And at that point, why not just acquire it for a couple cents when you need it, rather than pay how many thousands of dollars a month to store it, right? And $10 of ETH on something like Base gets you what, 5,000 transactions? like how much ETH do you actually need to store? And so that's kind of where that argument, like, sure, like the marginal cost to store this up into a point, but then once you're actually at a value where you actually have to protect for real, that the cost kind of goes exponential from there. At least, it's a step function, I should say.
Yeah, and I think that you can even look at this in a much like less analytical way and just think of like, okay, why is a business using Ethereum? It's probably to do something. It's to transfer this is the future we envision, right? Like to transfer an asset or to pay somebody with stable coins, and they are using it for its, utility function in this sense. And so it may be, we have kind of been conditioned to view these assets, right? Like in a lot of this either speculative or sort of cypherpunk. And I think John's original paper and then your paper, even maybe to a larger extent now with hindsight, has really hammered this down, which is like, look, the next sort of big unlock for crypto is institutions and, large financial actors. And they're looking at these as instruments to allocate capital productively, right? Like they may not have this cypherpunk vision of, oh, I got to keep this away. I got to go bury this in my backyard to make sure that the government doesn't come for it, right? So like it is a very different vision. It's also why, like I said, I think this is extremely helpful to view, a lot of these through this lens. Even if you disagree with it, which I'm sure a lot of people do, it's still helpful to understand at least where other people may be coming from, right? Where institutions may be coming from. Okay, I want to move a little bit to some counter arguments, Steelman, just some thoughts I had. I did address that like sort of carrying cost counter argument. So the first one, and I've just kind of bullet pointed these. The first one, I don't think we need to spend a ton of time on, but not because I think it's a zero, probability event. It's just a lot of it changes a lot of the framework of this conversation, which is if ETH becomes the non-sovereign store of value asset, we can apply a lot of the kind of store of value logic to it. What do you think of like I said, we don't have to spend much time on it again, not because I don't think it's guaranteed not to happen, but just because, it's not really, nothing really indicates that thus far. But like, what are your thoughts on that, right? Because this is what the kind of ultrasound money push was for.
Yeah, and like fair enough that if ETH does kind of dethrone Bitcoin in that role, and it is largely seen as the truly decentralized non-sovereign store of wealth, and Bitcoin is useless and just a meme coin, that there could be adoption and price there, and I don't disagree with that. But I think there's two kind of problems with assuming that will be the case. Three, assuming that will be the case. The first is the last 10 years have shown that that's not, and Lindy matters when people are looking at things as a safe store of value, right? And Bitcoin, God bless its simplicity, but that is what it does. It just sits there. It doesn't lose your money. You don't move it. It does its job, right? Whereas ETH, I think all of a sudden now you are dealing with far more expressive code. You are dealing with a lot more, like just the entirety of ETH. There's a lot of hacks and scams that go on underneath the hood, right? And as an institution, they look at Bitcoin and then they look at Ethereum, and they just don't kind of play in the same ballpark right now. Can that change? Absolutely, right? But I think probabilistically, and investing is just a probabilistic game, you'd probably be better off betting on Bitcoin in this case. Another problem with that is the whole what gives ETH its value, right? And this is one kind of counter to the counter that I haven't really seen a good rebuttal to, and that's Bitcoin doesn't need anything else to give it its value, right? It is just non-sovereign, it's permissionless, it's decentralized, has a supply cap. People get that story. It's simple. But that is the same story that you can tell Russia, Iran, China, US, Pakistan, like any country in the world, any person in the world, you can tell that same story to. With Ethereum, everyone's just really excited about BlackRock building and how much stablecoin supply there is, and XYZ. But the thing is that immediately and definitionally makes it like almost a NATO chain, right? Because once the US Treasury has control over all of the things that give that thing value. And I'm not talking about like, you know, the validators or anything like that, just at the application level itself. But if you were to take all of a sudden USDC out of the picture and all that, does that impact the value of Ethereum? Yes. I would argue yes, right?
Yeah.
Or MetaMask consensus, right? All of a sudden, things like this do impact the value of that chain. And there's not that same argument that can be made for Bitcoin. But in Ethereum, in say a World War III, so like if you really extrapolate this out, sure, the chain, like as it exists, and ETH the asset as it exists, are permissionless and decentralized. But all the applications on top that the US or any other Western government has jurisdiction over, they can just fork this thing or tell them to like, or any number of things can happen. And then all of a sudden now, that existing fork, much like ETH, like POW and anything like that, is worthless. And so if you're trying to look at something that's truly this like this neutral store value, Bitcoin, yeah, there's minor concentration and all that, but you can just stand up a miner in the world and contribute. With Ethereum, you can't just stand up another Circle. Or stand up another BlackRock and maintain that value, right? And so that's like the second piece that is really difficult to kind of suggest that Ethereum has the same attributes as Bitcoin, and a reason why I just don't think it's going to see that same acceptance. And then the third, and this is kind of you know derivative of those, is you need to use Ethereum for other things, and you don't need to use Bitcoin for anything else. So like, how often are you paying for your compute resources with gold? Or anything with gold? You're not, right?
Yeah.
And that's the same story with Bitcoin. But with Ethereum, as this kind of ultrasound money, you're also going to be using it to provision for your like meme trading. Like, no, it doesn't really make sense, right? It's either a super useful utility asset, which it is. Ethereum undeniably is, but that almost definitionally means it can also be this just thing you hide under your mattress, like gold, or digitally like Bitcoin, right?
Yeah.
And so that's kind of where it breaks down, I guess, three different levels.
Yeah. I guess well, yeah, you kind of touched on this. But another counter argument would be, okay, what if large financial actors, what if, whales, I think this is partially true now for what it's worth. But what if they're just willing to pay a premium to settle on Ethereum? This was another of the kind of, I would say, narrative pushes, was that Ethereum sells premium block space. I have some reservations about this. I actually talked to somebody from the Ethereum Foundation and I asked them, like, do you think that Bitcoin sells premium block space? And I think that in the long run, the answer to that is no. You should really assume that the marginal cost of production of a Bitcoin and its price, if you map them over time, should converge. Now, at any given point, some miner may have an efficiency gain or cheaper access to energy, cheaper ASICs, right? But what I'm saying here is that this is a commoditized industry. It's designed to be commoditized. There's very little rent extraction. Now, so when I hear this premium block space is sold on Ethereum, I think, okay, what do you think of this idea? Like, will BlackRock only settle on the Ethereum L1 and pay outsized economic rent to validators to do so?
Yeah. And so, I mean, I think to a certain extent, insofar as Ethereum stays more valuable than, for example, Solana, which is kind of like a circular argument there. But yeah, so Ethereum's blob space and block space generally is, as of right now, I would arguably say it is the premium option, right? And you do pay extra for that versus like Celestia, EigenDA, or any of these others that are in the market, right? And I'll just send on like the L2 space right now, just because that's kind of where the roadmap is pushing it, rather than L1 execution. And so I think to a certain extent that is true, right? But I think where you start to run into issues is that when you look at the next marginal business, we'll call them L2, L3, whomever, looks at like their business as in terms of what are their costs, what are their like revenues, right? Just their own financial statements, and they're seeing comparable, if not faster and cheaper options for, say blobs or posting their data. There's only so many that are willing to just really kind of pay at almost a blind adherence to that L2 for that Ethereum premium. And you are seeing this play out. Like there's a ton of different chains that are using these alt-DA layers, right? And so whereas maybe 2 years ago, before some of these things launched, Ethereum was going to get like a player in town, all of a sudden now you have multiple competing solutions with, some cases vastly superior products in terms of just throughput costs and all that, and just capacity, that there's only a limited number of people that are willing to pay up for that premium, right? And if these blobs, if these L2s do get congested, then all of a sudden now you do see them kind of play games between call data and just posting to blob space. You do see that. Why would they not also just add in for, hey, maybe it's like not a peak user time and it's cheaper. Maybe we just use Celestia, right? And you can see how that game does start to get played. And so I do think to a certain extent it's true, but increasingly, it's tough to say that that's like a defensible mode. It's like, oh, we have the premium block space, especially if other chains end up catching them in any way, or some of these other network effects. And I think that's a big argument. It's like the network effects of Ethereum are kind of unmatched still. And that's true, but like something like Celestia, like, do they build up enough where that's not enough of a differentiator? And I could see that being possible in the short to medium term as well.
Yeah, I think also, again, coming back to sort of the core framework here, probably one of the biggest misunderstandings in the space is that value capture is distinctly different from value creation. And that's probably, if I had to summarize, your paper, I think, focused, a lot on revisiting a lot of, principles, and it really dug in. John's was maybe a little bit more of just like a holistic framework for how he was viewing it. But if I had two takeaways in aggregate from your two papers, it's sort of like these two concepts. One, value creation and value capture are very, very different. And that these types of systems that we're dealing with are uniquely bad at capturing the value. Uniquely, right? Because the moats are very hard to establish. They're permissionless. They can be forked. They are almost structurally designed to extract very, very little economic rent. So that's the first one. The second one goes back to my other point, which is, okay, so then how do we come to valuation for something? And in many ways, outside of, sort of businesses or applications, it's who's most likely to be diamond-handed, like who is truly willing to personally take it upon themselves to lower the velocity of an asset. And what we've seen thus far are Bitcoiners are burying their shit underground and not planning to, dig it up for 100 years. And like, it almost is, I think it really screws with the minds of a lot of people in this space, because we've seen such massive premiums come into these tokens. And I really do think what has happened is, like, if you or I, not saying that I'm like some, very, skilled analyst, but if you or I were to see a company with that's, steady margins, but sort of, hard to define its moat, and maybe like a middle of the pack company. If we saw this and we saw it was trading at 50x earnings, we'd probably be like, maybe comps are trading at like 15 or 20x or lower, right? We'd probably be like, this is probably overvalued. Now, maybe there was some market shock or something that led to this overvaluation, but like, just given the like naive like details I've given you, we'd say, okay, this is probably overvalued. But what I think happened in crypto is that these things have gone to like 1,000x. And so people say, okay, well, hang on, like there's no rational way to explain this. Like, we must find sort of novel ways to justify the valuations on these things. And there was a quote that John had that was in response to one of his comments on his paper. And I think it's like, there's a lot to learn from this. He said, just as we can invent new objects, we can't change the laws of physics. We can create new assets, but we can't give assets new reasons to have value. And he said there's basically 3 reasons to have value: a collectible, a store of value, and a claim on cash flows, right? And a lot of what I have observed in crypto is like trying to mesh those 3 together and then add another 500x premium to it, right? And so that was a bit of one of my schizo rambles. I did want to you mentioned one other kind of counterpoint or argument that could be made is we had this bimetallic standard for throughout history. Or I don't know if it was bimetallic or trimetallic or whatever, but there were periods where gold and silver or gold and various other metals were viewed as currencies and gained some monetary premium. You talk about silver in your paper. What was the rationale to say, like, I don't know if this is such a great analogy here?
Yeah, well, I think the biggest thing there is there's not really any reason to think silver would be like a good comparison, right?
Yeah.
Like silver has like elemental characteristics that are unique to it, and that makes it the only thing that can be used for certain industrial applications. And then above and beyond that, I think silver has like something roughly 50% of annual demands for industrial use, which means the other 50% is kind of maybe you can assign that to the monetary premium or so, right? And so I reference silver in more that maybe that's a better framework in that. Sure, there can be some monetary premium. I'm not saying that doesn't exist. ETH is used to buy assets. ETH is used for a lot of the things still, right? But I think maybe something like that silver premium is a little bit more realistic than something like the gold, where it's almost majority of that's from monetary premium versus just that, and there isn't like silver isn't a rival to gold. And it's far more used in industrials in terms of, its share and all that. And so that's really the reason why I brought up silver there. If you really want to draw a tight comparison to silver, I think you'd be pretty disappointed in what that outcome is as well for ETH. Like 36 billion of annual demand and the thing's trading at 1.4 trillion. All of a sudden now divide that by 18, there's your ETH demand. All of a sudden, right? That doesn't really hold up as well as someone might think, in the 50 to 70 billion range, perhaps. So there is that as well, but it's more just that framework to think about something. Still very productive in use, some monetary premium there, but together it doesn't mean it's worth a couple trillion.
Hey, this is Will with Blockspace Media, and I don't know if you heard, but we just announced the 2nd edition of our conference series, Op Next, now to be held at the MicroStrategy HQ in Tysons, Virginia.
That's right. After the success of our first scaling conference at Fidelity last fall, we're doing it again this spring, April 11th and 12th at the MicroStrategy HQ. I'm really excited for the programming. We have various stakeholders, industry, developers, and Bitcoin miners present.
So join us in April for open, neutral, and honest conversation about the leading proposals and technical solutions that will scale Bitcoin to the next billion users. No booths, no tokens, no shills, just Bitcoin and honest conversation.
You can find tickets and more information at opnext.dev or click below in the show notes.
Okay, so now like the last part of this kind of ETH valuation I want to ask you about, and it's kind of putting you on the spot here, but where does this converge then in the long run? Because, like we have this equation of exchange, which if we see, the utility value of ETH ultimately kind of taking over, it's kind of insane to think, right? Like the delta between what ETH currently trades at and what its utility value would be. Where do you see this kind of converging then in the long run? I mean, do you have any like thesis around that?
Yeah, and so I think this is entirely path dependent, right? And that's a big reason why we wrote this. And if you've kind of followed a lot of the conversation, just that's happening, and kind of the ETH community, the Ethereum community, how they're responding to this, I think if the L1 execution is reprioritized, and all of a sudden now that burn is real, priority fees are real, execution still down, but people willing to pay that premium, that price discovery for that block space. I think there is a long run future where ETH does stay valuable. Is it at this 500 billion? That's tougher to justify. I'd suggest it probably comes down half an order of magnitude, if not a full one. But if it stays on this path, right, that this L2 kind of execution, this competing against all these other DA layers, and just really tries to be that settlement piece for what ultimately does become just a back end kind of tech product, I think you run into some issues with how much you can hope this thing is worth. Like a lot of the current demand cases that we're using, for example, like, you know, staking it in with or depositing an Aave to borrow and stuff like that, right? I think those things really came up due to inefficiencies in the market, people wanting to speculate, people not having a way to otherwise borrow against crypto assets. And increasingly, you're probably going to see a lot more as RWAs come online, treasuries, things like that, really eat a lot of that share. That's my kind of hypothesis there. And so you're going to see a lot of those use cases also start disappearing. And to date, that's kind of buoyed it a little bit. But if you take all of this together, right, the probably the decreasing use of those, and those are like, for all intents and purposes, velocity sinks, right? To your point, you want to start removing some of those
but
things.
Even like velocity sinks are they don't really work at equilibrium. Like you should see a reciprocal increase in the velocity of, like, in a naive example, unstaked ETH versus staked ETH, right? Like if there's a reduction in velocity, you should then see an increase in the velocity of unstaked ETH, which just brings us back to the same sort of equation. I'm wondering, so I asked John Charbonneau this, and I can't recall if he was saying if ETH pushes execution or if it settles on, or if it kind of retains this settlement layer, you know, exporting ETH, attempting, let's say, to export ETH the asset. But I can't recall what direction he was saying. But I asked him, I was like, okay, so then what is Ethereum worth in that scenario? And he said, well, if like a vast majority of like financial activity in the world kind of occurs atop this layer, then it should be worth, you know, it should be worth a lot. And I'm like, okay, so why? Like, but my point, which I didn't really press, was, what is the value of TCP/IP? Like, in my perspective, it is all of the money in the world. It creates incredible value, like the entire body of human knowledge and all of our coordination, right? Like run through these internet protocols, and yet its capture is, right, well, effectively zero, right? Apart from the open source funding that goes into it, which is that doesn't even really make a whole lot of sense. But is there a path where you see these, you know, smart contract platforms like going that direction in terms of they just kind of become these open source protocols that capture an extremely small amount in the long run?
Yeah, I don't think they go right to zero, because at the end of the day, information versus value is a different paradigm, right? As a first principle there. And there's arguments against that, for sure. But right, once you are secure, like these are the real funds online, not just like the messaging layer of like what Visa and MasterCard are actually doing, right? And so there is a little bit of a difference there. But I think in the long run, our kind of estimation is roughly, you might be able to see, you know, in the 10 to 20% of like similar value capture of like an on-chain, like at equilibrium, an on-chain protocol versus like what its kind of off-chain counterpart would be. 20% if they're able to really get that sustainable moat there, really, and build up enough ways to protect that. But given the nature of these things, and you can just like literally copy and paste code. I think compounds or Uniswap's been forked like 700 times, right? Like you can really erode a lot of that. And so I think you see it is probably closer in that 10%, but up to 20%, and that's probably where you'll see, for all else equal, kind of that value capture settle out. I don't think we should be looking at these things and be like, oh, it's X on chain and it should have that same revenue TAM, it should have that same capture mechanism in place, and I just don't think that's a reasonable way to look at it in the long run.
Yeah. Well, that kind of like pivots into our the last bit I want to talk about. Like, okay, so then we've raised some skepticism about maybe these L1s, for example. Is your thesis then that most of the value kind of accrues to the app layer?
Yeah, that's exactly right. And again, this is at like long-term equilibrium. There's still like plenty of a new L1 that's going to launch, and I bet you can find that thing sit at like 10 to 50 billion, and you as a short-term trader / investor, you can realize a lot of gains there, right? And there are still those inefficiencies around. And frankly, there is that much value capture possible. It's like a 10 billion valuation. That sounds more in line with what a truly adopted L1 can do, up to 100 billion or so, right? Like in that range. I'm not saying these things are all going to zero by any stretch, but I think as an investor, right, what you want to start looking for is, and then we lay this out in the paper, like we kind of like almost a 9 square way to think about this, a couple axes. You want to look at things that are like for profit and on the application layer, where they can use what the strengths of the blockchain, having the strength of like Ethereum or Solana or any of these chains on the back end, and really use that to undercut existing players in traditional markets, or provide something new that doesn't exist, but monetize those users in a way that you're actually just leveraging the strengths of the blockchain rather than expecting some crazy crypto premium because you're a blockchain company, right? And I think we're going to start seeing a lot more of that over the next little while. And then you kind of get into this question of like actual token or value captured by the tokens themselves. Yeah. And that's just a whole other thing, right? Some of these things can be like Uniswap is the perfect example for this. Incredibly successful, right? They're doing trillions of dollars of volume. The token sees definitely none of that at the moment, right? Right. And so things like that this is another layer here. It's like if you buy equity in a company, you can typically assume that you have some claim on the cash flow and the revenue and the profitability of that company, right? With a token, chances are you don't. There are some that really do, and I think with the new administration, this is going to change. We're very optimistic it will. But you're seeing this thing where some of them are these actual true value capture tokens. You have others that are what we call them like embedded nonprofits, right? Which is essentially like embedded as in like with an embedded call in there. So like you can value these things at what that call, like say you exercise that, aka governance turns on a fee switch or something like that. And so there's things there, but then there's also what we call like these kumbaya DAOs, which there's just
most of them
exactly. And they are like, sure, like some of these protocols are providing a lot of value. They're doing cool stuff, but like they're not really investable from an investor standpoint, right? And that's totally fine. But for the ones that are sufficiently valuable, because of how easy this is to like fork and all that, someone will just copy and paste that code, add a token, make some tweaks, and then all of a sudden now you have a for-profit version of it, right? And you'll probably see a lot of this migration happening over the next year or two. But so as investors, that's what we look for, right? We look for things that, as far as you can in crypto, build up moats, build up, defensible positions, have the true users, have the traction, have the token value accrual with some way for that actually to come through to you. And some of these things, like they're few and far in between, but like you can earn 40, 50, 60% like yields on true that just pass through from revenues from these protocols. And you get that and you can turn around and sell that. And that is value that you have captured. And you're seeing them grow like hockey stick charts, right? And that's what we look for. And they exist. But if you go down, CoinGecko and top 1,000, vast majority of those aren't that.
Yeah, it seems to me that the Fat Protocol Thesis is basically dead. I don't know if it was a good idea at the time. It seems increasingly like it's just not going to turn out to be true. I think it looks like crypto is going to very much mirror Web 2 in many ways. Like the applications built atop and the defensible moats, which may counter some of the ideological inclinations of a lot of people. But, it does seem like the applications that can really, sort of build strong network effects as a result of, like real genuine moats are the most likely to kind of see that outsized value capture.
And on that point though, right? And so one of the amazing things about crypto and why we love it so much and are optimistic about the next couple of years is, up until now, a lot of these mechanisms have been kind of sidesteps, right? Like these buy and burns and stuff like that. Yeah. And now if that design space really does open up, you might start seeing, and we're optimistic we will, is kind of a convergence around models that are truly like kind of funneling value back to those token holders. And then on that like Fat Protocol piece, if you look at some of the new things like, enshrined apps that for an L1 token. So like I think Hype's doing certain things like this, right? And some Cosmos chains have tried this in the past as well. But all of a sudden you are tying those applications to that L1. And so like as like a Fat protocol, it kind of blurs that line a little bit.
Yeah, exactly.
Right?
Yeah, I think the Fat Protocol thesis may have just like been the wrong explanation, because like differentiating app between protocol now is a little bit more cumbersome, and like I do tend to agree with that. I mean, I think that I'm coming more back towards thinking there's this value capture mechanism in these tokens. You're a liquid fund, so I assume you have like fairly strong feelings about this. I was kind of black-pilled, I think, in many ways, when I sort of assume a lot of the same logic that we apply to kind of what we just talked about for 45 minutes, valuing L1s, and very hard to define moats. And also we're in such a speculative phase that a lot of the kind of understandings of how these work may not work at equilibrium. And I also think about like little things like, these large financial actors we're talking about, BlackRock and Citadel and Bridgewater, they're not going to be plugging in to the Uniswap front end. They're going to hit the smart contract. So when you can sidestep a lot of these, perceived moats, that's when, but what has kind of changed my mind, ironically, is more like the consumer side. Like I look at Pump.Fund and I see those founders like sending literally hundreds of millions of dollars of SOL to Kraken. I'm like, okay, you can build, right, like applications where the money goes to equity holders like this. There's no token right now, equity holders. Now, is this sustainable? I don't know. Is Pump.Fund like a long-term, sustainable? I don't know. But these things can crop up, and there are consumers, mainly retail users, who will go directly to those things. In terms of like the broad financial system, I think that, for example, for Citadel to switch, it's going to have to be less extractive than the venues where they trade currently. And I don't know that we can really reconcile that with a lot of the front end app like extraction methods currently. I don't know, but like that's why I'm coming back around, maybe from seeing stuff like Pump.Fund, but I'm coming back around to the notion. Okay, there is value to be captured. Just like it's hard to know where yet, and like I'm not really personally I'm not betting anywhere big on, but like I assume you guys do.
Yeah. No, and I think that's right, at least in the kind of the short to medium term, right? At the end of the day, some of even the biggest protocols out there, like your Iradiums, your Aerodromes, they've been around for right, like not very long. And so you will probably see a lot of reluctance with some of the bigger TradFi people moving in. But at the same time, I think things like fintechs, especially, and a big barrier here has been just the lack of the regulatory clarity, and like people just want to know what sandbox are actually playing in. And really, Mika out in Europe is a good kind of start there. And you are starting to see an openness of fintechs as front ends are willing to plug into some of these protocols on the back end, right? And kind of take advantage of some of the benefits that it provides. And I can see a world where it's really more the fintechs first as kind of moving in. And that slowly will crack open the door to bigger and bigger players. But for any of the big shops to really get comfortable with this stuff, you're going to need a lot more Lindy. You're going to need a lot more, like, there's a lot that has to happen for these guys to really move in at size. Even the ETFs, like, just from an investment standpoint, let alone a business integration standpoint, an investment standpoint, you still don't have Vanguard or Charles Schwab or Morgan Stanley allowing their clients to buy Bitcoin, right? And that's through an ETF. So if you're thinking those are the guys that are eventually going to come on chain, we have to really take a lot of steps forward to get there. But kind of a little bit more risk averse, venture funded fintechs, I could see them being the first guys in.
Yeah. I had one last question. It's totally out of order, but I just wanted to clarify, my personal view is that a lot of what we said regarding ETH can also be applied to Solana. You may have slightly different views, like with regards to execution, which I understand. I'm still of the opinion that kind of a lot of the same convergence on utility value, if you will apply to Solana as well in the long run. And that a lot of these kind of, even on the execution side, like a lot of apps capturing the value and a lot less like MEV being extracted will sort of be less attractive as an investment perspective. But I wanted to ask then, you do seem to have thoughts that, like, if Ethereum was to prioritize the execution roadmap, it would put it in a much better spot. Do you think that, do you think that Solana has a big edge now? And also, not to have you put like numbers on this, but like how much more value capture is enabled with, sticking with something hardline execution style, monolithic chain, if you want to use that?
I think this all comes down to like each ecosystem's kind of relative stage of development, right? ETH, its libraries, its developer community is just so far ahead. A lot of these other ones that they are already kind of reaching this point of all this abstraction, all this, plus having that roadmap that's explicitly pushing away business from their core business, right? And on these more monolithic chains, if you just look at, you mentioned REV, which I still think is probably the best way to look at just the total economic activity and capturable value that these chains are generating right now. Like MEV is, one way to look at it is just the inefficiencies that still exist on a chain, that their opportunity to actually internalize through, Flashbots, GTOs, whatever, and pass that through to validators and thus the stakers, right? So that is really economic activity that you can internalize with enough development. And ETH is just further along that path than others. But on this like monolithic side, if you look at these things as cash flowing assets, and there's this, base fee to transact, which is negligible. But for specific use cases, for specific instances, at like Solana's local fee markets and stuff like that, even this last weekend was a great example of this. You saw spikes, like the average the median cost to transact didn't budge. So anyone else just sending SOL around doing whatever is fine. But people are willing to pay high premiums for a very specific use for a time box time, right? But if you then kind of extrapolate that out, if these chains do reach this mass adoption, this mass scale, and you're having all these local fee markets and people are willing to pay premiums to access that block space at that time, at critical mass, all of that does ultimately come through to the stakers, right? On these. And that there is a true cash flowing view on these things, and gives a lot more reason to actually hold these assets. Now, the balance is, does that outweigh its kind of collapse to that productive asset value that we've hit on, right? And they probably converge to that point, which is, what is the economic activity needed that you can actually justifiably expect from staking? And that's, to John's point, something has to have like this cash flow, claim on cash flows to be worthwhile, because I don't think anyone's saying Solana's a collectible. Right? No one's saying that. Or store value. Like no one in the market is saying that. And so you see a convergence to where the actual global demand for this asset, for that compute, versus the actual fee generation enabled by all the activity happening passed through the validators to the stakers. And I think that's probably that convergence you get. Do I have a firm number on you? For you, Off the top of my head, I don't. I probably need to go back and model this. But my gut sense here is that's in the tens of billions. So
right, but yeah, the irony in this is like with this context, right? Like if you were to tell me that okay, Ethereum trades at 5x Solana, but Solana's doing the same amount of REV, with the framework that John originally put forth, and then you have now extended upon, my first thought is, oh, okay, they're both overvalued by 1 or 2 orders of magnitude. And that's, in a sense, by the way, if they win. Like that's the assumption that they also win, right? So as opposed to, Solana should be worth $900 to be, have the same market cap as, I don't know the exact number, right? But like should have the same market cap as Ethereum. That's not my initial thought. Now I understand in the short term, if you're, doing a pair trade, it makes sense. But I guess my point is we've been quite, critical, or we've been, we really dug into ETH's valuation. I just, at least from a personal level, wanted to say that a lot of the same rationale in my mind applies to Sol and Solana. I think Tolly's okay with that. I don't think he says this, I don't think he says so explicitly, but that is at least my perspective. Like, it's not necessarily that one is deeply undervalued. It's that they could both be, extremely overvalued with this framework, but, they should be maybe trading at a similar valuation, if you will.
Yeah. And that's one way you can look at it. Right. And so I think to that piece where each chain is kind of has its own time frame here, right? And ultimately, these valuations, and most people would agree that so many assets are overvalued based on any fundamental. And this is really due to a lot of inefficiencies that are still in the market, right? And a lot of people are trying to price these new to the world assets through like essentially liquid venture lenses, trying to ascribe traditional cash flow multiples. And so we'll get there as an industry, we will get there. But a lot of this is like, if on the short term, right? So we're talking a year to 3 years. Some of these items that we've just discussed for the last hour and a half are probably honestly out the window. And there's a lot of inefficiencies, structural and otherwise, that can lead to these assets being worth 150 billion or 400 billion, right? And it's proven out that that's the case so far. But if you, where we're taking this is like over 5 to 10 years, there's just nothing. If we're expecting from these levels rationally based on adoption, based on the roadmaps and all that, to expect, you have to underwrite these at 30-40% a year based on the risk and frankly the opportunity cost of what else you can be putting money to work in this industry. Not to mention,
that's my rationale. Right? I mean, like literally, like I take this barbell approach, which is like, okay, I have made my bet sort of like on Bitcoin long run store value. Of course, I could be wrong. On the other side of it, I'm like, okay, I want like 100x's, right? Like, and that's why this like middle of the road kind of valuation. I understand you guys have to deploy more capital, right? You have to like put in real size. I'm not aping size on my little Telegram bot, but like it's the same. I think it's exactly to your point there.
Yeah. And so just to like kind of wrap that up is actually right. Like, is Solana undervalued versus Ethereum? If you just take the same top-down approach, look at how much value they captured the last 2 months, and then look at the relative growths. If you just take those numbers on paper, it's tough to say that you want to invest in Ethereum instead of Solana, right? But at the same time, if you look at Ethereum's TVL, its network of networks, how developed that ecosystem is, you look at Solana, you're like, this thing is tiny compared to what's going on here. Like, users, transactions, not accounting, right? And so it depends how you really look at these things, and so it's very much the short-term inefficiencies and where we are today, and being realistic about that versus where we think we're going over the long run. And so as investors, you kind of have to balance those things, right? So if we're putting on size some things, we need to be very sure that like we're not trying to swing trade this thing 3 months later, right? Or or anything like that. And so that's kind of how we view a lot of this, but being realistic about a lot of the dynamics we've touched on, where you might not have you might not be the market leader in 6 months, right? We're pretty certain Google's going to be Google in 2 years from now, right? Maybe antitrust stuff won't go into that, but right? But Uniswap, there's arguably people would rather go to Radium or Arrow, or
Pump.fun,
or Pump. Exactly.
Yeah.
Right. And so it's just you have to be really realistic about how you're time boxing what you're looking at. I think that's kind of what it boils down to.
Awesome. Well, Kevin, thank you so much. This is fascinating to me. I think I will be sure to link the paper. I think everyone should read it. I also think everyone should read the original paper. I appreciate you doing a follow-up. It was fantastic. I think you guys covered it very well. I hope that this doesn't come across too bearish, right? Like that's sort of I've always loved Ethereum on the grounds that I think it can create tremendous value, right? I've just always been very much influenced by what you wrote and what others have written, right? Like the capture aspect is sort of where I have more qualms. So thank you so much. We'll have to have you on in the future. I appreciate it.
No, thanks for having me. It was great speaking with you.